let's continue on now. We're going to be looking at transactions in the journal. So I've got an example of a journal here, and then how we put these transactions into their respective ledgers. So on the board here, I've got two ledgers, cash, and I've got the capital account ledger. Okay, these would actually be separate pages, but I'm just doing this on the board so we can see what happens. But the journal would be one thing, our general journal, and the ledgers would be something different. Okay, the journal it keeps a chronological order, all the transactions that take place. So all of our journal entries, all of our transactions are put in the journal, one right after the other. And then our ledger helps us to track the balance in every single account. So cash has a ledger, accounts receivable has a ledger, supplies has a ledger, equipment has a ledger, accounts payable, all the revenue accounts have their own ledgers. So every single account has its own ledger. Okay, let's look at some transactions here. Let's say this is a brand new company and the owner puts $10,000 into the business. So the account would be cash, and our owner is Mr. Jones. So I'm going to put down B. Jones Capital. Okay, and I said $10,000, so oops, wrong thing. So we're going to debit cash because a debit increases cash and a credit will increase the capital account, because capital is an equity account and it increases with the credit. Okay, kind of confusing, got to remember that. All right, now what I'm going to do is, this is the journal, and it's page 1. It's the very first page of our journal. I'm going to put this transaction into their respective ledgers. So what I do is I put down the date. Now this is the cash ledger. I put down the date, 5/1. If there's anything special that I want to explain, any sort of notes I want to put down, I can put that here. I'm not going to, because I have what I call here the posting reference. PR stands for posting reference, where I can say where this is coming from. And I'm going to put down G1, which would be the general journal, page 1. So if I want to see where these numbers are coming from, I can go back to G1, which would be the general journal, page 1. Now, this is 5/1, it's the cash journal. What's happening to cash? We're debiting cash. So right here, under debit, I'm going to put 10,000. There was no credit, and so the overall balance in my cash account is $10,000. Okay? Now up here, it has a posting reference. What I'm going to put is, where is this dollar amount going? Okay? Accountants know that this amount has to go to an account. So I'm going to put down account 101, which is my cash account. See right here, account 101? Now remember, this is going to be a separate page. It's a separate book. It's a separate ledger page that tracks the cash balance. So right now my cash balance has 10,000, and here's the journal entry. So I've cross-referenced it. If I want to see where that's going, 101 would tell me account number 101. So I go to the ledger 101. And then here, if I'm looking at this, I want to know, well, where did this 10,000 come from? I could look here, G1. Me being an accountant, I know that means general journal, page 1. Okay, now we have to look at the second part of the transaction, B. Jones Capital. Okay, I have down here, it's kind of low, but I have down here B. Jones Capital, and I'm going to put down the date, 5/1. I'm not going to put down an explanation, but posting reference is going to be the same because it's coming from the same page. That's G1. There's no debit because this is a credit, so I'm going to put down $10,000 credit. This is the normal balance for an equity account, for a capital account, I should say. This is the normal balance for a capital account, so I'm just going to put it as a positive number. Okay? If you ever debit this account, it would reduce this overall balance. Okay? Let's do a second transaction really quickly. Let's say that we're buying some supplies with cash. We're buying $100 worth of supplies. So we would debit supplies, because supplies is an asset, and it increases with a debit. And now I said we were paying for it, so we're going to credit cash. Okay? Now, let's say supplies is account 102. All right? So I would go to account number 102, and I would put this transaction. I don't have it written on the board, and I don't have room for it, so I'm not going to write it up. But there would be a separate page that would say supplies, and I'd put the date. It would be May 5th, 5/2. I would put down it's coming from page G1. I would have $100 debit, and then I'd have a balance of $100. Okay? That would be my entry into the supplies ledger account. Okay? So that would be done. Now I've got to go to my cash account. Okay? I do have the cash account written here. It is it's account number 101, so I'm going to take this and put it in 101. I'm going to put the date 5/2. It's coming from, hopefully you recognize this, G1, because it's page 1 of the General Journal. Okay, now this is a credit, so it's going to be $100 credit. And so now what's my overall balance? Well, I had 10,000, now I'm crediting it, so that's a reduction. So I'm going to reduce this by $100. So it's going to be $9,900 is my balance in my cash ledger. Okay, hopefully this makes sense to you. Just a step-by-step, looking at the journals versus the ledgers. The journals have all of the transactions one right after the other. The ledger tracks the balance. So if someone ever asks me, what's the balance in cash, I don't go to the General Journal. I'm going to go to the ledger. I look at the bottom of the ledger and I can see, oh, my balance in cash is $9,900. Every account has its own ledger. Every account has its own ledger. All right, good luck.